So I was walking downstairs to record this video and my son goes to me, Tata, what's today's video about? And I replied to him, stock market, covered calls and a few other things. And he goes, what's that? And I'm like going, this is exactly why I'm recording this video. And I replied to him, look, when you're old enough, watch the video and you'll understand. So this is exactly why I'm doing this video series, to shortcut the learning process basically for my kids. And if you can get something out of this as well, great. So this is a step-by-step instruction of what you should do. It's just a door for you to understand, hey, this might be worth looking into. It's basically a filtered list, a shortcut of what you should look into further. And that's what all of my videos is about. It's not a deep, in-depth instructional piece on this. It's basically, we don't know what we don't know, right? But if I can sort of open the door and go, hey, here's what's available, maybe look into this, that's exactly it. And, instead of now my kids trying to figure this out in the future, now they've got a list of 4 things that they can look into if they're thinking about looking into the stock market. I hope this helps. Here's a video. So in this video, I wanted to cover 4 ways that you can get into the stock market, at least the 4 ways that I've seen which are valuable enough and which will benefit you enough. So before I get into it in detail, let me cover them off quickly. First one is value investing, which you've heard about from Warren Buffett. Second one is identifying trends from Main Street before it gets to Wall Street. Third one is ETFs, mutual funds, and index funds. And the fourth one, I'll keep that as a surprise for later on, okay? Hi, my name is Opie. I talk about health, wealth, and happiness. So before I start this video, I should let you know this isn't my bread and butter, but I know enough for me to speak about this so you can actually dig a little deeper and find out more about these topics. Obviously, there are other ways to invest and grow your portfolio in the stock market, but out of all the strategies and techniques that I've seen, these 4 seem to be the most logical sense to me. I've seen people who do day trading and take on that very seriously. But in my inner circle, people who I actually know, I haven't seen this to be any success. I have heard this, I've seen this in movies, day trading taking off. But as I said, in my inner circle, I'm yet to see anyone that I personally know who has actually made money consistently year after year doing day trading. This is why I've sort of honed it back to the fundamentals of these 4 strategies. So let's get started, right? The first one is value investing. And value investing is you basically look at a stock, go into the fundamentals of it, who the board is, the directors, what the unique selling proposition is, how their balance sheet looks, all the fundamentals of a company. And you make a decision if you want to be a shareholder, if you wanted to be part of that company. These days, it's so easy to do this because especially with all these AI tools, you go in there and punch it in and it'll give you a full-on report of a particular stock or shares. Even if you don't have these AI technology, you actually can leverage providers who will give insights and buy call as to go, hey, this particular stock is considered undervalued because of this, that, and this reason. And it's very easy to find. So I'm not going to give you any recommendations as to some of these companies because if you're watching this a few years down the track, this list would have changed. But doing fundamental research is enough for anyone to do. You don't need to, in my mind, you don't need to learn all the technical analysis, right? Because the technical analysis of charts and stuff is very short-term thinking. This first strategy of value investing is you're investing for the long term. You're buying into this company as if you're, owning it. And essentially, you are, because you are owning a little piece of it. Therefore, you are wanting to know the fundamentals of the company. And if you think it's worthwhile, you go into it with both feet, thinking that it's going to be a long-term investment. And that's how Warren Buffett made his millions. Okay. First one is value investing. Second one is identifying trends in the main street, our everyday life, before Wall Street, the big boys and girls, find out about these trends and pick up on these stocks. So there's a great book by Chris Camilio, who wrote Laughing at Wall Street. And the premise of this book is this guy ended up starting with $20,000, converted that or made that into $2 million within a space of 3 years. And what he did was he basically tried to find everyday things that you and I use that we will see, just as, we're spending time with our kids, going to the supermarket, going to daycare, going to school, going to work. We're identifying things that institutional investors are not seeing. And he covers a bunch of examples, which I've actually forgotten because it's been a couple of years since I've read the book. But you identify these little trends and you go, wow, this has got the potential to boom. And again, I wouldn't consider this a long-term strategy, okay? This is done more so to the point where you're getting into the stock early enough that as soon as the institutional buyers identify the trend, that trend that you identified maybe 12 months, 2 years down the track, once they get into it, all that institutional money comes in and then the stock booms. And at that point in time, you make a decision if you want to exit out. So not a long-term play, but I would say 2 to 5 year play where you can use your everyday knowledge as an everyday person and just keep your eyes and ears peeled to things that can boom. So that's the second strategy. Third one is plain and vanilla investing in index funds, mutual funds, and exchange traded funds, ETFs. So what are these? If you haven't heard of these before, these are, index funds. They're a fund that mimics the stock market index. Okay, so you would have heard of the S&P 500, the Russell 2000, the Nasdaq. All of these are a group of funds in the stock market, and these index funds basically mimic that, and they go up and down depending on what happens in those indexes. The thing is, these prices don't change it on an hourly basis. This is index funds that we're talking about. They are the price is set on a daily basis, and you buy into a group. So the most famous index fund that's out there, I think the first one started in 1976 by a gentleman called Jack Bogle, and his one is called Vanguard. Depends. Vanguard Australia. I can't remember what the American one's called, but probably Vanguard. And he started the whole concept of index funds, and that is for you to invest in a very passive way, because the risk is very much mitigated to the point because you're buying into a pool of stock, not just one single stock, but a pool of stock, and you're doing this for the long term again. That's index funds. ETFs are individual stocks which also mimic the stock market, and they do change, hour to hour. I don't know if they change minute to minute, but they change more than once a day. One of the most famous ETFs is the QQQ, which mimics the Nasdaq 100, if I'm not mistaken. So you could do that, and you've got a bit more flexibility in there because it's like you buying another stock. You could go in there, buy it. When you're ready to sell it, you sell it. The transaction is quite easy to do. The third one is mutual funds, where the fees are a little bit higher on that. But if you can find a good mutual fund that has got a history of good performance, it might be worth getting into. Dave Ramsey, the author that I spoke about in my earlier videos, he is a big fan of good mutual funds. The fees, as I said, are slightly higher than an index fund, but the returns might be greater, so you might be better off going with a mutual fund. Again, this is not financial advice. This is just a starting point for you to dig further. So that's the third one: ETFs, index funds, and mutual funds. The last one is probably my favorite and is probably the most active one that you can get into if you wanted to get into the share market. So all of these three, the first three were relatively passive, right? Once you bought into it, generally you can sit back and relax and forget about it and keep an eye on it every now and then. This one is a little bit more active, and it's what's known as covered calls. So there's a couple of books that are written about this, and one of the best books that I've read is by a guy called Alan Ellman. Here we go. Several books. I mean, look how this one is Encyclopedia of Covered Call Writing. It doesn't need to be this complicated, but he's written, end to end of it. Caching covered calls, that's there. And the last one is the Exiting Strategies. So he's a master, and if I remember his story correctly, I think he's a dentist by trade. I might be wrong. Let me just see if I can quickly get his... He became a licensed general dentist, certified personal trainer, and a licensed real estate agent. Anyway, he got called to discuss real estate strategies, and he was talking about real estate, blah, blah, blah. And the audience asked him, "Hey, Alan, how are you funding all of this?" And he basically said, "Oh, look, I've on the side, part of the money that I'm getting from a cash flow perspective is actually not from real estate, is by writing covered calls." So if you don't know what a covered call is, it's basically you go out as an investor. If you're in America, you buy a certain stock once you've done research on it, and you buy 100 of them, 100 pairs of stock. So as an example, if we buy the Apple stock, we buy 100 of them, package it up into a group called a contract, and then we put this back into the market to rent it out. Okay, but basically put an option out of it. Someone else comes and looks at the stock and say, look, the stock is trading for $50. Obviously, it's not the actual price at the moment, but they will go, "Hey, I would like to have the option to buy this contract, and at the end of the 30 days, I am happy to give you $5 premium for each stock, or $2 premium, whatever the premium is, and we'll see what happens at the end of the 30 days. So they've given you a fee to have the option to buy this contract at the end of the 30 days. Okay, now the 30 days has gone by. What will happen? Three things will happen. Either the stock will stay the same price, it'll go down in value, it'll go higher in value. If it's gone down in value, is there any point for this person who's giving you a premium to buy it at a higher price? Because what they've agreed is at the start of the 30 days. At the end of the 30 days, if it's gone down, why are they going to pay you more? Because they can just go out of the market and buy it at a cheaper price anyway, right? So they're not going to pay you the $50 price if it's gone down to $48. Does that make sense? So at that point in time, the option would expire. But the good news is you, as the contract seller, would be able to keep that premium, whatever the premium was, $1 or $2 or $3 or $4, whatever dollars per contract that you got, you can keep that premium. If it stayed the same question will be asked. If it's gone up, same question will be asked. If it's gone up, they may decide to exercise that option and actually buy it at the original agreed price. Okay, you don't get that value of the increase, but you've still got that premium. Making sense? So by you doing this over and over and over and over again, you end up getting a bit of a cash flow. This strategy is affectionately known as renting out your stocks. Because in the traditional world, you don't, if you have a house, you can rent it, you can give it to some tenants, and the tenants will give you some cash flow, right? Sort of, you can do that in the terms of getting dividends, but this is a far more active way of getting some sort of cash flow from you holding the stock. Hoping that made sense. Maybe not. If it's not, look into some videos on covered call option writing. There's heaps of them out there. Alan has got a ton of videos. Amazing guy. He reminds me of my grandfather for some reason. Might be the whitish hair, but yeah, he's a knowledgeable guy. He's actually got a business about this, behind this, called the Blue Collar Investor. And by the time you're watching this video, I hope business is still around. He's an older gentleman now, so I hope that business continues to flourish even when he's not around. The reason why I said that is he basically provides a service, which is a subscription-based service, and he tells you which contracts to buy, because there is a bit of analysis that's required in regards to buying the correct stocks. And that's what obviously this book covers, but because it's a thick book. But if you didn't want to go through this analysis process every month, he will tell you, hey, here's a list, buy from all of these and you should be good. And his predictions have been generally good because he actually follows a process, very systematic process that he goes through. I think that's it. Okay, 4 steps that I have. Well, some of them I have used, some of them I haven't. This covered calls option I definitely have, and I made money from it. A great option if you want to get into it seriously. Obviously, the first option is really good as well, just looking into stocks and holding them long term. The second one is, you're gambling a little bit there, because the second option is you're trying to identify trends and speculating that Wall Street will pick it up while it's in Main Street. So that one is the only speculation one. But have a read of Chris's book. Maybe you might get some tips out of it. And the third one is probably the most safest one, where you're buying into an ETF or an index fund or even a mutual fund. Thank you very much for listening. Again, not financial advice. This is just a starting point for you to start researching into these topics a bit more. I'll see you in the next video. Thank you very much. Bye.